Welcome back to the Deep Dive. Our mission here is always to take a complex stack of sources, the research, the reports, the technical analysis, and turn it into knowledge you can immediately use.
Yeah.
And today, we are strapping in for a deep dive into the absolute frontier of finance. We're looking at the future of exchange-traded funds, or ETFs. We are diving into a really comprehensive report that highlights the structural trends that are, well, they're transforming the ETF from a simple passive vehicle into a sophisticated high-tech financial platform.
And this couldn't be more timely. I mean, the ETF story over the last decade, it hasn't just been one of growth. It's been, explosive, unrelenting transformation.
Even against enormous global headwinds.
Exactly. And just to give you, the listener, a sense of the scale we're talking about, the global ETF market hit a new record high of over $11.6 trillion in assets under management at the close of 2023.
$11.6 trillion. Just saying that number out loud, it requires a pause. But what's even more staggering to me is the velocity of that growth.
That's it. It's the momentum factor that truly defines this market. I mean, that 11.6 trillion figure, it effectively doubled since just the beginning of 2020.
Doubled in about 3 years.
An astonishing feat, really, especially when you consider the periods of high volatility, the inflation spikes, the interest rate trauma we've seen in that time frame.
Yeah.
And analysts fully expect this momentum to continue accelerating. They're projecting that global ETF assets will surge to $25 trillion by 2030.
And what's really remarkable is that 2023 was a year defined by, let's call it financial anxiety, right?
Oh, absolutely.
You had central bank tightening everywhere, a mini banking crisis with SVB and others, the massive rescue of Credit Suisse in Europe, and, escalating geopolitical conflict.
And yet,
the ETF market not only survived, it powered through, attracting record inflows.
it's just undeniable proof of investor preference. Investors are continually choosing the ETF wrapper because of its intrinsic benefits.
Right.
The low operational cost structure, the flexibility of intraday trading, and the transparency that allows for a kind of a real-time view of performance. It's just becoming the preferred vessel.
Okay, so let's unpack this shift. We aren't just looking at the market getting bigger. We're looking at it fundamentally changing its DNA. We've identified 3 key areas, the report calls them frontier trends, where the industry is moving from, incremental growth to real structural transformation. We're going to cover the massive acceleration of active management,
Yep.
the transformative power of artificial intelligence in portfolio construction,
Right.
and the fundamental operational overhaul promised by tokenization.
And why this matters specifically to you, the learner, is this. These 3 trends together are shifting the identity of the ETF. It's no longer just a cheap index tracker.
Not at all.
It is rapidly becoming the most high-tech, sophisticated platform for accessing complex and dynamic investment strategies quickly, efficiently, and crucially, at a significantly competitive cost. This isn't a product update. This is the future operating model of global asset management.
So let's start with that first one, the active acceleration. For decades, ETFs were, they were almost synonymous with passive indexing, right?
Completely.
Tracking the S&P 500 or a global bond index. But that legacy narrative is collapsing. The sheer speed of growth in the active ETF segment is staggering.
It really is.
Assets in this category have grown a whopping 250% since 2020. They've reached $700 billion by the end of 2023. So it now represents over 6% of the global ETF market.
That 6% market share figure is a little misleading if you only look at it in isolation.
How so?
Well, the growth rate is the real signal that we are reaching a definitive tipping point, especially in the U.S. market. If you look at the product development side, 2023 was a watershed moment. The majority of new ETF launches in the U.S. market actually fell into the active space. The pipeline for new investment vehicles is no longer dominated by index funds. It's now dominated by active strategies packaged in the ETF wrapper.
That is a profound shift.
It is. It changes how asset managers conceive of and distribute new products.
So we have to ask, what specific combination of factors is powering this meteoric rise in the U.S.? What makes the ETF wrapper so undeniably superior to the traditional mutual fund for these active strategies?
It comes down to a sort of a perfect confluence of 3 powerful structural drivers.
Okay.
Firstly, you have the inherent tax benefits of ETFs, which are a massive draw, particularly for U.S. investors. Secondly, you have the more efficient cost structures that ETFs allow. And thirdly, just the simple benefit of greater tradability.
The intraday trading.
Exactly. Investors can buy and sell throughout the day at market price rather than waiting for that end-of-day net asset value calculation that defines mutual funds.
Let's drill down into that tax advantage, because that feels like the true secret weapon the ETF has against the mutual fund in the U.S. How exactly does that work for an active strategy?
This is the technical nugget that every portfolio manager is focused on. In the U.S., ETFs benefit from a unique mechanism called in-kind creation and redemption.
Right.
So when a traditional mutual fund needs to sell a security to rebalance or meet redemptions, it sells those shares on the open market for cash. If those shares have appreciated, the fund generates capital gain.
Which then get distributed to all the remaining shareholders. The dreaded capital gains distribution. You get a surprise tax bill just for holding the fund.
You got it. The ETF, however, primarily operates through what are called authorized participants, or APs.
Okay.
When an AP redeems a block of ETF shares, they don't necessarily get cash. Instead, the ETF manager can hand the AP the underlying low-cost basis securities in kind.
So they just give them the actual stock.
Exactly. This transfers the appreciated assets out of the fund without ever executing a sale on the open market. It minimizes or even eliminates the realization of capital gains within the fund itself. It's a huge competitive advantage.
And we're seeing managers recognize this superiority not just by launching new products, but by wholesale converting older traditional products. The moves by JP Morgan and Fidelity, I mean, that shows absolute conviction.
It's more than conviction. It's a necessary move for survival. They're future-proofing their core business. They know that if they don't offer their flagship strategies in the more efficient ETF wrapper, their competitors will.
But this raises an important question, right? Are these conversions truly benefiting the investor? Or are they, in some cases, converting struggling mutual funds that are losing assets?
That's the skepticism you need. I mean, are they migrating successful funds, or are they using the tax efficiency of the ETF to effectively clean up the portfolio of a fund that has been languishing for years?
Giving a fresh start.
It's often a blend. They are placing new capital in the most efficient structure, and they're using the conversion process to rationalize their offerings. The strategy may be sound, but the distribution vessel is now just undeniably better.
Now, that managerial shift also forced an evolution in how the product is structured, especially around transparency. When active ETFs first started gaining traction, the biggest hurdle was this fear of giving away the secret sauce.
And that fear was legitimate. It directly led to the first major wave of structural innovation. Managers were worried that if they disclosed their full daily holdings, as standard ETFs do, rivals or high-frequency traders could front-run their trading decisions.
Which led to semi-transparent ETFs.
Exactly. The SEC authorized them back in 2020. These structures were designed to protect the manager's proprietary strategy by only disclosing holdings periodically or by using a proxy portfolio.
Yet, if we look at the data now, those transparency concerns seem to have been, well, largely overcome.
Dramatically. And this is a critical market signal. If you look at the current landscape, less than 2% of total active ETF assets today are held in those semi-transparent structures.
Less than 2%.
It shows that the market, the investors, the APs, the market makers, has voted decisively in favor of full transparency.
So why is that? Why is full transparency so important that investors are demanding it?
It all comes down to liquidity and trading efficiency. Full transparency allows market makers to price the ETF shares with maximum accuracy against the underlying net asset value throughout the day.
And that means tighter spreads.
It results in tighter bid-ask spreads, which reduces the cost of trading for the end investor. The semi-transparent models, because of that informational gap, often result in slightly wider spreads, making them less attractive. The market chose liquidity and efficiency over opacity.
And all this acceleration is creating immense pressure on the traditional actively managed mutual funds.
It's a classic disruptive technology scenario. It's forcing fee compression across the entire asset management landscape.
And the numbers starkly illustrate this. I mean, ETF's share of global regulated open-ended funds has jumped from under 7% in 2013 to over 15% by 2022. Mutual funds are just unequivocally losing market share.
This is the existential challenge for them. Managers who are reluctant to switch are not just stagnating, they're losing flows year over year. And the fee compression data really drives this point home.
So tell us about the fee comparison. How significant is the cost saving?
It is substantial enough to move billions of dollars. The average management fee for an actively managed U.S. ETF was 0.44% in 2022.
Okay, 3.44.
Compared to 0.66% for a similar actively managed mutual fund. That 22 basis point difference, compounded over decades, represents thousands of dollars in savings for the investor.
So the question is no longer whether they can afford to cannibalize their existing funds, but whether they can afford not to.
Exactly. The implication is clear. Mutual fund fees must continue their long-term trajectory downward, trending toward ETF levels just to retain capital.
Hmm.
And that's not even counting the tax efficiency. The total cost of ownership is just lower.
Okay, so that's the U.S. market. Now, let's pivot to Europe, which has historically been much slower to adopt active ETFs. Why the lag?
Initially, the lag was attributed to a perceived lack of demand, but the consensus has shifted on that. The core issue in Europe has largely been a lack of supply and, well, structural complexity.
How so?
Europe operates under the UCIT's regulatory framework, which has different rules, and the market is fragmented across numerous countries, currencies, and complex cross-border tax regimes. It makes a large-scale launch way more complex than in the unified U.S. market.
But as U.S. managers have perfected the model, they're now eyeing Europe as the next massive growth avenue.
Precisely. We are seeing major players step up. Franklin Templeton and JP Morgan have recently launched significant active ETFs in Europe. JP Morgan's entry was particularly impactful. They quickly used their global scale to climb into Europe's top 10 ETF promoters by the end of 2023.
But the regulatory complexity has forced some firms to get really creative.
That's where the innovation gets interesting. You look at the approach taken by HSBC. Instead of launching a brand new fund, they opted to launch exchange-traded share classes from their existing global fixed income index fund.
So they just sort of bolt on an ETF share class to an existing mutual fund.
That's the idea. It's a potential game changer, but it's not a simple flick of a switch.
I can imagine.
Far from it. While it's conceptually brilliant, this path runs into significant regulatory and taxation hurdles. They need to navigate the nuances of the UCIT's directives and make sure it works across all the major European jurisdictions. It's complex, but it signals the industry's intent.
So looking ahead, the market signals are pointing toward an imminent and significant acceleration in Europe.
Absolutely. We see major strategic moves like Cathie Wood's ARK Invest acquiring Rise ETFs, specifically to gain a quick regulatory and distribution foothold in Europe.
That's a big move.
It is. And you have Dutch provider Robeco hiring experienced ETF veterans, indicating their plan to launch into the active market in the second half of 2024. The U.S. hit the active tipping point in 2023, but 2024 is shaping up to be the breakthrough year for active ETFs across Europe.
It's clear the active wrapper is transitioning from a niche curiosity to the default vehicle. Okay, let's bridge to the next section. We've established the wrapper is getting smarter. If active management is taking over, what happens when you infuse that portfolio with superhuman analytical intelligence?
That brings us to the intelligence explosion, the integration of artificial intelligence and machine learning. For the general public, the fascination with AI really erupted in 2022, right?
With ChatGPT and all the generative AI tools.
Right. And while those are impressive consumer applications, in the financial world, the application of AI is moving beyond that and into the profoundly practical. It's fundamentally changing how active investment decisions are made.
So we're talking about AI not as a chatbot, but as a hyper-efficient, nonstop research assistant, risk manager, and predictive portfolio tool.
Precisely. The core function of AI for asset management is its ability to analyze vast amounts of information from highly diverse sources far more quickly and thoroughly than any human team could ever manage.
And we're not just talking about market prices and filings. We're talking about unstructured data, too.
This is where it gets really interesting. We're talking about inputs that provide genuine alpha. This includes analyzing the full text of quarterly earnings call transcripts to gauge CEO sentiment,
Right.
or scraping social media sentiment at scale in real time. It involves synthesizing alternative data streams, things like geolocation data on consumer foot traffic to retail locations, or satellite imagery showing capacity utilization at manufacturing plants.
So it's identifying patterns hidden within all that noise.
And that distilled, timely research then assists portfolio managers in making significantly more informed investment decisions.
We often think of AI as only impacting the front office, the stock pickers. But the report highlighted that AI is actually being integrated across the entire value chain.
That's key to understanding its structural impact. It's being integrated everywhere. While it aids active managers in constructing portfolios, that's the smarter decision-making part, it's also making huge strides in back and middle office functions.
Like what?
Think about drastically improving efficiency in regulatory compliance reporting, automating transaction cost analysis, and enhancing real-time risk management. It makes the entire operational infrastructure smarter and more resilient.
And we're starting to see entirely AI-powered ETFs emerge from this, the next generation of active funds.
Yes, these are already active in the market. We have specific examples like the Wisdom Tree International AI Enhanced Value Fund and the VanEck Social Sentiment ETF.
Okay.
These funds use advanced machine learning algorithms trained on enormous quantities of historical and real-time data. This training allows the AI system to rapidly identify emerging patterns and execute decisions far quicker than any human-led investment committee.
So if you're comparing a traditional human-led active ETF to one of these, what's the key competitive advantage the machine brings, beyond just speed?
The key advantage is a combination of speed, consistency, and non-emotional decision-making.
Right, taking the human bias out of it.
Exactly. AI-powered ETFs are inherently quicker to react to market events. They can process inputs and rebalance in milliseconds, and they offer a degree of flexibility that index tracking ETFs completely lack. They operate on pure data signals, eliminating the human biases of fear and greed.
Okay, here's where we need to introduce the necessary caution, which the report emphasizes. When you introduce complex black box technology like this, you have to be vigilant about unintended consequences.
Absolutely. And the report highlighted critical challenges. The most significant is the risk of algorithmic biases.
How so?
Well, if the machine learning algorithms are trained on historical data sets that contain latent historical market inefficiencies or sector preferences, the AI will simply perpetuate and amplify those biases in its future decisions.
So it could systematically overlook compelling opportunities just because they don't fit the historical pattern.
Precisely. And that speaks directly to the need for human professionals to interpret, manage, and audit these systems.
You can't just set the machine loose with billions of dollars.
Not at all. The integration of AI relies absolutely on having skilled human professionals, data scientists, quants, experienced managers to manage, interpret, and crucially, veto the results generated by these systems when they produce nonsensical recommendations. You have to maintain investor trust.
So it sounds like AI isn't replacing active management, but it's making active management exponentially harder for anyone who doesn't use it.
That's the correct way to frame it. AI is a powerful complement, enabling smarter, faster, and more efficient processes. It's an accelerant for the active trend, confirming its role as a prominent force shaping the ETF future.
We've discussed the evolution of the strategy active and the intelligence driving it AI.
Yeah.
Now we move to the final and perhaps most disruptive frontier trend, tokenization. This is being heralded by some as the next evolution of the ETF, which suggests a complete structural overhaul of how we define asset ownership.
And to understand the promise of tokenization, we have to recognize the massive regulatory and market validation that digital assets just received.
You're referring, of course, to the monumental January 2024 decision by the U.S. SEC.
Indeed. The SEC approval of 11 spot Bitcoin ETFs in January fundamentally changed the segment's perception among mainstream financial institutions. This was regulatory acceptance.
Right.
This single action shifted a largely unregulated space into the mainstream, leading to regulated assets in the U.S. jumping to nearly $53 billion by the end of January.
Wow.
And this SEC approval is seen as a key step, paving the way for wider familiarization with and adoption of digital assets and their underlying technology blockchain across mainstream finance.
So the assets themselves are now validated. But tokenization goes much further than just crypto. It's about applying that technology to all financial assets, and it's linked to the industry's obsession with faster settlement.
That's absolutely right. The pursuit of tokenization is being accelerated by existing regulatory pressures to speed up the trading life cycle. The immediate goal is the impending move in the U.S. and Canada from T+2 settlement to T+1 in May 2024.
Moving to T+1, meaning transactions settle one day after the trade date. That sounds like a huge win for efficiency, but it must create profound challenges for the global ETF ecosystem.
The challenge is enormous, and it revolves around liquidity mismatches.
Okay.
If an authorized participant is facilitating a trade for a European ETF that holds U.S. stocks, they have a problem. The U.S. security held by the fund will settle in T+1, but the ETF share itself, trading on a European exchange, often settles on a T+2 cycle.
So the AP has to bridge a 24-hour time gap across jurisdictions and currencies. What's the practical pain point for them?
The pain point is funding costs and collateral risk. The AP needs to deliver cash or securities in the US on Tuesday, but they don't receive the corresponding securities or cash back from the European market until Wednesday.
So they have to pre-fund their positions for that 24-hour gap.
Exactly. They have to tie up significant collateral and potentially borrow funds overnight, incurring additional funding costs. It adds friction and cost to international ETF trading.
And we expect the pressure to shorten the cycle in Europe, too, just to maintain global parity.
It's inevitable. Once T+1 becomes routine in North America, investors will push aggressively for ESMA to follow suit. But this only gets us halfway. The ultimate question is, once the industry achieves T+1, will they demand they shorten the cycle again to real time?
And if the industry wants to move beyond T+1 to something closer to instantaneous, there's really only one viable technical answer.
That is the consensus. Tokenization is the solution. It offers the potential for true, real-time, or instantaneous settlement. Moving transaction records onto a distributed ledger, a blockchain, means the exchange of value and ownership can happen nearly instantaneously. 24/7/365.
And the utility of this extends far beyond just speed for stocks. It unlocks efficiency for assets that have historically been almost impossible to trade quickly.
That's the game-changing component. Tokenization enables the immediate digital fractionalization of asset ownership. This vastly increases the efficiency and liquidity of trading in traditionally illiquid assets, like private equity, real estate, or complex fixed income.
So you can fractionally sell tiny pieces and establish a secondary market for what was once the most illiquid part of a portfolio.
Exactly. It democratizes access. It transforms the private markets by allowing smaller investors to gain exposure while providing fund managers with new sources of permanent capital.
Given the scale of this, it sounds like the industry is actively preparing for this future.
They are, with extreme focus. The report highlights that the industry is working on numerous pilot projects. Crucially, institutions are choosing to tokenize the issuance of fund shares,
So the ETF shares themselves.
rather than tokenizing the underlying asset.
And why that distinction?
Regulatory clarity. Tokenizing a share of a regulated fund keeps the whole operation within existing regulatory oversight. Tokenizing the underlying assets, like a commercial property deed, creates far more complex, currently unresolved legal and property ownership issues.
So they're taking the path of least resistance.
So the smart path. And regulators are watching closely and providing guidance. For example, the UK's FCA and the Investment Association are actively developing a blueprint for tokenization implementation. This suggests the structural changes required for instant settlement are a matter of when, not if.
So we have an asset class moving from 11 trillion to a projected 25 trillion, incorporating AI-driven active strategies, and now aiming for instant, real-time settlement through tokenization. This brings us to the ultimate, almost philosophical question.
The most important long-term implication.
If we achieve real-time settlement, if assets can be traded, settled, and validated instantly on a distributed ledger, does the very operational structure of the traditional ETF wrapper become obsolete?
That is a critical thought to end on because it perfectly synthesizes the three trends we've covered today as synergistic forces. These trends are not operating in isolation.
Let's quickly review the powerful dynamics that are converging.
First, we have active management, moving aggressively from niche to mainstream. It has proven itself superior in cost, tax efficiency, and distribution.
Right.
Second, AI and machine learning are providing the essential technological edge, driving efficiency, enhancing risk management, and allowing for smarter, faster portfolio construction.
A reaction time that humans just can't match.
And third, tokenization offers the necessary structural overhaul. It addresses the friction of the existing settlement systems, promising instant global trading and liquidity.
So what does this all mean for you, the learner? This isn't just arcane market structure talk. This trifecta represents the future operating model of finance. It's characterized by three defining elements: speed, intelligence, and unprecedented accessibility.
And that leads us back to the provocative thought, the longevity of the ETF wrapper itself. The traditional structure relies on a complex, manual, and delayed operational process.
If an asset is traded and settled instantly on a digital ledger, the core operational mechanisms that define a traditional ETF, the daily NAV calculations, the complex creation-redemption cycle, the manual reconciliation, all become redundant.
Or at least severely diminished in importance. The ETF may transition from a regulated legal fund wrapper to a sophisticated, regulated smart contract platform offering direct, fractional ownership.
So the question is not if this fully digital ecosystem will arrive, but how quickly it will move from pilot projects and regulatory blueprints to becoming the market standard.
Exactly. Will the $25 trillion projected for 2030 still be housed in ETFs as we currently define them? Or will we be discussing a completely new, digitally native fund vehicle? That transformation, moving from a multi-day settlement process to instant global transfer, is what you need to be watching in the coming years.